Okay, so we're going to crack on now, and we're going to look at business inflation in the United States, PPI finished goods, excluding food and energy. And the code that we're looking for when we go looking for the statistics is PPI LFE. So again, publicly available data, and the general code used is here, PPI LFE. And the ex food and energy business inflation stats, the PPI ex food and energy, they're released at the same time as the stats that include food and energy prices during the second week of each month for the previous month by the Bureau of Labor Statistics, the BLS. And we're going to be going later, when we move over to the spreadsheet, we'll be going to this link here, to the St. Louis Fed again, to download the data. And you can follow this link at any time to download the data yourself. The data goes back to 1974, so not quite as far back as the stats including food and energy, but it's still a pretty significant data set. And it's calculated in exactly the same way as the PPI finished goods number including food and energy. However, the goods included in the set do not include any food items and items that are linked to the price of energy, including oil. And the PPI finished goods number, ex food and energy, is sometimes called the core PPI because it measures core inflation in the United States. So without having any exposure to international food and energy prices, which can obviously, as we've already seen, be volatile and subject to exogenous influences in the global marketplace. And again, just to highlight this point as a reminder, don't confuse the PPI final demand numbers with the finished goods numbers. The final demand numbers are the ones that are reported every month by the media, but the data only goes back to 2009. The core PPI number distributed by the media is the final demand PPI ex food and energy number, and not the one that we're looking at here. What we do is we monitor PPI finished goods ex food and energy because the data goes back to 1974. And it's obviously still very useful to us to look at excluding food and energy, so the core PPI, because what we're doing here is we're gauging inflation and or deflation, and therefore we're gauging the possible reaction by central authorities, in this case the Fed, the reaction of central authorities to current inflation, and in this instance business inflation. So the reaction is going to be linked to monetary policy, so either interest rates or money supply, and that reaction is going to be based on the inflationary expectations of the central authorities. So obviously monetary policy is going to be affected here. So this is why it's still important, and this is why it's still useful. So how do we actually go about analyzing this data? Well, you've guessed it. We're doing it in exactly the same way in which we analyzed the PPI finished goods, including food and energy stats. We calculate a distribution of returns to discover what is normal and what is abnormal in order to scorecard inflation and deflation. So we basically take the monthly rates and work out percentage changes on a month-by-month basis. And we look at a trailing 12-month number to gauge inflation or deflation in consumer prices ex food and energy, and compare this number to the historical distribution of percentage changes and to what is normal and abnormal. And what we're also going to do in this video is compare PPI finished goods ex food and energy to the PPI finished goods number including food and energy. And for the sake of repetition in this video, we're not going to be showing you how to do this again in Excel. However, all the data series and analysis is available for download in the endogenous driver analysis spreadsheet. So for the purposes of not repeating ourselves too much, because you should be pretty used to this process now, we're going to go and dive straight into the stats. So when we're analyzing the PPI X food and energy, we can take the historical numbers and we can basically learn what is normal and what's outside the bounds of normality. And to do that, again, we take the distribution of monthly percentage changes and look for the differences in the behavioral nuances of business inflation and deflation. So we're, again, looking at the monthly percentage changes and looking to find out what's a normal month, what is a normal situation, and what is an abnormal month. So what's an abnormal situation? Again, we discover immediately when we do this that there's a lot more positive data points than negative data points. So a lot more inflation than deflation. So everything to the right of here. So 0 to 0.5, 0.5% to 1%, 1 to 1.5%, and greater than 1.5%. So everything to the right hand side. And when we compare monthly increases to monthly decreases, the monthly increases outpace the negative months by a factor of around 8.5 to 1. And the long-term monthly average inflation rate in the US is confirmed to be spot 2.735%. So this is PPI, average business inflation rate, X food and energy. And when we look at only the cases in the positives and the negatives separately, in an average up month, we should expect 0.36% when we compare to historical data. And in the average deflationary month, we should expect to see, on average, around minus 0.2%. And the frequencies we can see here as 81% of data is up months, 9.5% of data is down months, and we have our zero cases here at around 9%. And when we look at the probability adjusted rates of inflation and deflation, probability adjusted monthly inflation is 0.2935%. And the probability adjusted average deflationary month is minus 0.02%. Now, if we continue to look at the standard deviation statistics, we can further learn again what is considered to be normal. So what are the bounds of normality? Well, our bound of normality here, our one standard deviation of our sample, is spot 3456%. So as referenced from the descriptive statistics for PPI X food and energy. And in the upper bound, so in the positive data side of the distribution, one standard deviation is 0.619%. And in the lower bound, it's minus 0.72%. And 80% of months fall between these values. When we compare that to a normal distribution, one standard deviation is 68.2%. So that basically means that PPI finished goods, excluding food and energy, in the United States is again following this pattern of being peakier in terms of the distribution, so much more cases relative to a normal distribution around the mean, but with much fatter tails. And then in between, we have, when compared to a normal distribution, a more vacuous scenario. So we have a peakier distribution, but with fatter tails when compared to a normal distribution, which we've seen in many cases before. So you can see here that the way in which the distribution of monthly moves in PPI inflation X food and energy is extremely similar to our previous inflation stats and other macro data we've looked at on a distributional basis. So you should be getting fairly familiar with how we treat this distributional pattern when looking at macro numbers. Our sliding scale works in pretty much exactly the same way. We've basically got to approach this in a way in which we look at inflation, in this case PPI, business inflation, X food and energy. We look at inflation between what is normal and what is abnormal. So the sliding scale has to take this into account. So we won't be scoring highly for normal rates of inflation and growth. If there is inflation, we will have a short currency bias, but if it's within the normal bounds of inflation, as evidenced by the historical data, again, we're not going to assign a high score to normal levels of inflation. Now, a major short bias score in the currency will occur again when there's significant deflation. And that's because history tells us this only occurs in 9.6% of months, so in the significant minority of months. And whenever monthly deflation occurs in the US, this is usually during GDP contraction and the Fed acts. Now also, when we look at zero inflation, we can look at zero inflation as deflation as well, because it's not very common. It only occurs in the zeros 9.2% of times, and usually during GDP contractions. Now, when deflation is small, so begins creeping, we tend to have a high conviction long currency bias because it's not common. We get 47 months out of 493. And when deflation is extreme, a short currency bias predicting inflation is the way we're going to look at it, because it's going to be apparent that the Fed will act sooner rather than later. So again, we're going to have this way in which we look at the extremes in the deflationary side of our sliding scale as an opportunity for a short currency bias predicting inflation. So you can see the process overall in the way we're approaching our sliding scale is very similar to previous inflation numbers we've looked at and previous macro numbers, because in the extremes, we know that the Fed will act. Now, on the other side of our sliding scale, so on the inflationary side, if you go into the spreadsheet and filter for values greater than 1%, you'll find that there's very few cases. So there's only 16 cases of monthly PPI X food and energy above 1% since records began in 1974. And you'll see that many of these occurred after the oil crisis of 73 to 74 and in the real GDP contractionary period of 1980 to 1981, when inflation was basically out of control and real GDP was getting hit hard. And as we know, extreme inflationary pressures tend to occur when there's significant growth in the economy or at the end of cycles prior to slowdowns or deflation, or even when the Fed aggressively acts to spur inflation in a crisis. And this again adds fuel to our argument earlier that in periods of severe deflation, we have to have an extreme short currency bias. So again, we're looking at the extremes here of a severe deflationary period and a severe inflationary period. So in the inflationary period, similar to PPI finished goods, which is including all items, similar to the scoring there, we're going to have a short currency bias on extreme inflationary moves. Now, if we go through the same process as earlier and we start to look at inflation against our GDP stats pictorially, we can start to map onto our PPI numbers, our monthly percentage changes. We can start to map onto that GDP levels that are associated with normal business inflation. And taking this same approach, we're going to look at scoring low conviction numbers on the inflationary side when we're in the bounds of normality. Now, when we look at the chart here, and you can go into the spreadsheet and have a look at all the data behind this chart in your own time, we can see that since 1974, PPI X food and energy, the average has been trending much lower. And we can see now that a 0% number is associated with 0% GDP, and our long-term average is dropping from around 0.5% down to basically almost zero. So we can see that around 0.25% of PPI X food and energy over this entire data set is equivalent to around 1% of GDP. And we know that is around the bounds of normality. So this is how we start to, again, build our scorecards. And when we look at this pictorially and zoom in to recent times, we can get a further understanding when we zoom in on how monthly percentage changes in PPI are associated with certain levels of GDP. So if you look across the spectrum here, you can see most positive numbers are going between 0 and 3%, 2%, and most inflation numbers are coming in at between 0.25% and 0.5%. So we can basically see zero inflation is generally associated with zero GDP growth. 0.5% is generally associated with 2%, 0.25% with 1%, and if we go even higher, 1% is generally associated with 4%. So when we get higher levels here, with a time lag, we tend to get higher levels of growth. However, this never normally lasts for too long, because you can see in this example, in late 2008, we do also get a big move down, so a big negative monthly percentage change, and later higher levels of growth drop and go to more normalized levels. So we're getting a full understanding here of how things work in terms of PPI X food and energy relative to levels of real GDP growth. And we're also getting an understanding of what levels of inflation, PPI X food and energy, are associated with certain levels of real GDP growth. And our scorecards work very similar to previous examples. As you can see, during benign to within the extremes, so normal ranges of inflation, so plus and minus 0.34%, we have two areas. We have our long bias area and our short bias area. And when deflation occurs, we tend to have a high conviction long currency bias, because a slowdown is usually an occurrence of tight monetary policy or due to a negative economic shock. And we score deflation high in conviction terms relative to other data sets, because zeroflation and deflation so we've accounted for 0 as deflation here, doesn't happen often at all. It only happens in total in 18% of times, 18% of months. And when inflation occurs within this range, we tend to have a short currency bias, and high growth is usually an occurrence of normal or loose monetary policy. And future policy is to tighten or normalize on extremes, so extreme positives outside the normal bound. So let's put all of this together and try to cement exactly what's going on here again. So keeping an eye on our scorecard on the left as we go through things, the closer we're going to get to extreme deflation, so this area here, the higher the likelihood of a future loosening monetary policy. And the closer we get to extreme inflation, the higher the likelihood of future tightening or normalizing, unless, of course, there's a significant crisis, and this must continue. We have a neutral bias, then a short bias up the positive side of our PPI X food and energy scale. We know that prices spend most of their time inflating, 81% of the time, and at a predictable and normalized rate of around 0.35%, which is why we score a short bias but low on the scale. When zeroflation or deflation occurs, which is 19% of the time, it's more likely, or more than likely, that the Fed is reacting to overheating in order to deflate. And this isn't a common occurrence, as we've seen, which is why we score higher for a long currency bias in deflationary periods versus a short currency bias during normal inflationary periods. Now, one interesting point again is if you count the scorecard occurrences, there's 13 in total. 9 of them are inflationary short currency bias, 3 are deflationary long currency bias, and 1 is neutral. The scores are also in absolute terms higher on the short side in the inflationary areas in terms of predicting inflation. So basically for short currency bias versus long currency bias. So we have more of them and there's more extremes. And throughout history, you'll see stimulus when economic crises occur. That's again designed to counter deflationary conditions by causing inflationary pressures. The more deflation that occurs, the more conviction we have that it's going to be dealt with by the authorities. And in the opposite, we have a fall in conviction from here to here when significant inflationary pressures occur. That's because when inflation gets out of control, it's more than likely that the future policy from central authorities, the Fed, will be to tighten. And we then may enter a deflationary period, and we have to be prepared to switch from here to here. So from a short currency bias to a potential long currency bias. So again, we're trying to be flexible here as traders analyzing the macro data. We systematically score it and we try to be objective in our bias. So again, this is something you should be picking up quite naturally now and should be quite familiar to you, as we've seen in previous videos when analyzing inflation and macro data. So what do we get when we apply the 12-month rolling number? Well, the average monthly price change over the last 12 months is spot 1235%. So the average 12-month percentage move in PPI X food and energy has been 0.1235. So if we look on our scale here, that's between 0 and 0.25. So depending on how conservative you want to be, how aggressive you want to be, you can score this 0 or somewhere between 0 and -6. So if we're being conservative, then we'll probably be scoring a 0 to this indicator, to this driver. One point to note, the last 12 months have all been inflationary months, so between 0 to 0.2639, and that's basically all within the historical normal range, but it is tending towards below average. So it does seem like that a fall in oil prices that have occurred recently, as evidenced by PPI, including food and energy, which provided us with a deflationary number long bias, could be seeping over and creeping into other items in the US economy. And we're going to be conservative and score probably around a 0, but we do need to still be aware and have a look deeper into the numbers and really understand them, so we understand when things happen, where everything is moving and where things are coming from. Okay, so that concludes PPI X food and energy. Let's go over to the trading desk for a quick recap.
Okay, so welcome back to the desk. What did we learn there from the PPI? Well, we looked at PPI including and excluding food and energy. What we learned from the PPI including food and energy is that it's actually pretty common to get zero inflation or deflation throughout the history of the data. And including food and energy prices, we drilled down into the numbers and we found that similar to the PPI, there is occurrences throughout the history of the PPI, including food and energy, where there's evidence of volatility in oil prices causing many of these deflationary periods. And what we also discovered was that in recent history there's many of these cases, and that's really down to oil prices historically being very high and having large percentage moves followed by big percentage down moves. And we realized that 37% of the time throughout the history of the data that we get these deflationary periods because the PPI, including food and energy, is inherently linked to the volatility of oil prices. And when we looked at the numbers recently, we saw that recently this has been the case. The big move down in oil that's happened in the last 7 months has been the main contributory factor towards deflation in the PPI, including food and energy, and the CPI, including food and energy. So we have to actually look at this and understand why it's happening. And we scored a deflationary number for that economic variable. Now, we also have to look at it excluding food and energy. And what we saw was that actually in recent months, the numbers for ex-food and energy have started becoming more deflationary. So we're seeing less inflation because of this. We're starting to see lower oil prices creep in to other areas in business inflation. And when we look at them both together, it's actually quite similar to the CPI that we get situations where we get zero inflation or deflation in the ex-food and energy numbers. These tend to be quite rare occurrences. So we applied the same process overall to the PPI as we applied to the CPI, and we've now got a nice broad overall picture of understanding of how inflation works, both for the consumer and businesses in the United States. And we've got a systematic process of scorecarding this moving forward as part of an overall endogenous systematic process, which is part of the overall process to get to a point where we have a bias in the currency, in this case, the US dollar. We're going to input these inflation numbers, these inflation scorecards, into our overall endogenous scorecard as drivers that contribute to our bias. So we're going to continue now to move on to our next economic number as part of the endogenous process, employment. And employment is really important, but often misunderstood by retail traders, as we'll find out when we go over to the next video in employment, and I'll see you on the other side.